Welcome to Inside the Deal. I'm Suzanne Stevens. With me today is Garai. Gabor chairs the private equity and venture capital practice at Foley and Lardner. Gabor, you wrote an article for The Deal magazine recently that kind of highlighted the survey that you guys do of emerging technology companies. You've been doing it for 4 years. Obviously, the outlook was not overly optimistic, to put it mildly. But I want to dive into some of the details a little bit. And I know 74% of respondents certainly expect to be having access to less capital. How do you think that might actually play out in their strategies? What are the things they're going to be doing to get by on less?
It's basically focusing on your core product, your core competence, and your core markets. And everything else is just slashed down to the bone. So the idea is making sure that you have the money that you need to be able to get to the next phase where you can get the next round of financing for the key product. And that's all that really matters.
Gabor, the survey did show that some companies are getting funding, though. We saw Black Duck Software, for instance, recently got a $10 million capital infusion. At the same time, though, certainly the investors are getting more favorable deal terms. What are some of the things you're seeing?
Well, it's all about value creation and value protection. On the value creation side, what you see is companies are getting, say, $10 million, but instead of getting that $10 million all at once that the company puts in the bank and decides how to use, now the venture capitalists are saying, we'll commit $10 million, but we'll dole it out in pieces tied to value creation events. So the first piece might come out when you come up with a prototype. The second piece when you sell to your first customer. The third piece when you set up your distribution network. So it's all about what the money is used for and to make sure that it's going to actually create value.
So actual milestones, like an earnout that you might see
pretty
in
much the
M&A.
same one. And the other piece of it is something that I call value protection. So what we now see is something that was the vogue 10 years ago, but hasn't been very popular recently, which is called ratchet anti-dilution protection. So somebody's raising $10 million at $2 a share. That share has the right that if a subsequent financing is at $1 a share, they get an extra share for free. So basically, whatever happens in the future to the value of the company, you're going to get that benefit.
Are these deal structures that have been around for a while, but we're just seeing them come into use a lot more right now?
These deal structures have been around, but they haven't been used in a competitive environment. And there are some issues about using these deal structures because when things go well, these deal structures can undermine the company's ability to get new financing. But in this particular environment, the company just swallows this particular problem and figures they'll live with the consequences tomorrow.
Gabor, based on what you're seeing in your practice, what's your outlook for emerging tech companies in 2009?
I think that companies that are showing very strong progress are going to be able to get money, but much less than they were able to get before. And companies that are not meeting their milestones are going to just go down the tube. Venture capitalists are pruning their portfolio, and they know they're going to have to put more money into every company that is successful because they're not going to be able to go out into the market and do an IPO or get new financing. So they're going to reserve their cash for those companies that they know are going to succeed, and they're basically going to jettison the other ones and just not spend any time on them.
Gabor Garai with Foley Lardner. Thanks for coming by.
Thank you.
I'm Suzanne Stevens. Thanks for watching Inside the Deal.